In 2018, Argentina's central bank raised interest rates to 60%. 60%. And it didn't work. The peso was collapsing anyway. People were converting their savings into dollars as fast as they could. The government was burning through foreign reserves trying to defend the currency. And the whole time, Argentina owed tens of billions of dollars to foreign lenders. Not pesos, dollars. Which meant every time the peso weakened, the debt got bigger. Not because they borrowed more, just because the math changed. This is the original sin of emerging market finance. And it's destroyed economies over and over again for half a century. Here's the setup. Poor countries need money to build things. Roads, ports, power plants, hospitals. They can't fund all of it from their own tax revenue, so they borrow. But here's the problem. If you're the government of Kenya or Pakistan or Turkey and you try to borrow money from global investors by issuing bonds in your own currency, almost nobody wants them. Why? Because your currency isn't trusted. Investors worry it'll lose value. They worry about inflation. They worry your central bank will just print more money and dilute everything. So they demand extremely high interest rates to compensate for the risk. Sometimes so high it's not even worth borrowing. But if you borrow in dollars, suddenly the interest rate drops. Way down, because the dollar is stable. It's trusted. It's the global reserve currency. So the deal looks better. You can borrow more. You can fund bigger projects. The math works, except there's a catch. You earn revenue in your own currency. You collect taxes in pesos or rupees or lira, but you owe debt in dollars. That mismatch is the trap. Let's walk through how this breaks. Say you're a government that borrowed $10 billion when your currency traded at 10 to 1 against the dollar. At that exchange rate, servicing the debt costs you $100 billion in local currency every year. Tough, but manageable. Now let's say your currency weakens. Maybe there's a global shock. Maybe commodity prices fall. Maybe the US Federal Reserve raises interest rates and investors pull money out of emerging markets to chase higher returns in America. Suddenly, your currency trades at 20 to 1. Your debt just doubled. Not because you borrowed more, just because the exchange rate moved. Now it costs you $200 billion in local currency to service the same debt. Your tax revenue didn't double, your economy didn't double, but your debt burden did. And here's the worst part. When your currency starts to weaken, investors panic. They pull more money out. That makes your currency weaken further, which makes your debt even more expensive, which makes investors more nervous. It's a death spiral. This isn't theory. In 1997 and 1998, this dynamic destroyed Thailand, Indonesia, South Korea, and half of Southeast Asia. They'd borrowed heavily in dollars during the boom years. When their currencies collapsed, the debt became unpayable. Indonesia's rupiah lost 80% of its value in 6 months. Companies went bankrupt. The government defaulted. The IMF had to step in with emergency loans, but only after forcing brutal austerity measures. Millions lost their jobs. Turkey has been trapped in this cycle for years. In 2018, the lira crashed and Turkey's dollar-denominated debt exploded in local terms. In 2021, it happened again. The government keeps trying to stabilize the currency, but the debt keeps getting heavier. Sri Lanka borrowed billions in dollars to fund infrastructure. When tourism collapsed during COVID and the currency tanked, the debt became unbearable. In 2022, the country defaulted. The government ran out of foreign currency reserves. People couldn't buy fuel or medicine. Same pattern, same trap. So why do countries keep doing this? Because the alternative feels worse. Borrowing in your own currency means paying much higher interest rates up front. It means borrowing less. It means slower growth. And if you're a politician trying to build hospitals and win elections, that's a hard sell. Borrowing in dollars feels like a shortcut. Cheaper, easier, more efficient. Until it isn't. The irony is that the system punishes you for being poor. Rich countries with strong currencies don't face this problem. The US borrows in dollars and earns in dollars. Japan borrows in yen and earns in yen. If their currencies weaken, their debt doesn't explode. But if you're an emerging market, you're stuck borrowing in someone else's currency, which means you're vulnerable to forces completely outside your control. A Federal Reserve decision in Washington, a commodity price swing in global markets, a shift in investor sentiment halfway around the world. Your economy can be doing everything right, and you can still get crushed. There's a deeper problem here. The more countries borrow in dollars, the more powerful the dollar becomes, and the more powerful the dollar becomes, the more countries feel forced to borrow in dollars. It's a loop that reinforces itself. Right now, emerging markets owe over $10 trillion in foreign currency debt, most of it in dollars. That's $10 trillion in financial exposure that has nothing to do with whether those countries are well managed or productive or growing. It's just exchange rate risk. And every time the dollar strengthens, which it tends to do during global crises, that debt gets heavier. All at once, for dozens of countries. The system concentrates risk in the worst possible way. So here's the question. Why do we accept a global financial system where the poorest countries are forced to take on currency risk they can't control, while the richest countries don't? And what happens the next time the dollar spikes?